Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, and I have Dan Nathan on the line. He is a co-founder and editor of Risk Reversal. Dan, how you doing on this holiday week?
I'm doing fantastic. Thanks, Joel. Thanks for having me.
Our pleasure. So tell us a little bit about your background. I saw you worked at SAC and a couple other places, also on the equity derivative group of Merrill Lynch. When were you at Merrill?
Correct. I was there during the meltdown, actually,
Ah,
in 2000, 2008, in the early part of 2009, but which is really actually kind of an interesting place to be, believe it or not. Although it was, a little precarious for bits during late 2008. But like you said, I started my career in the business in 1997 at a then pretty small hedge fund. SAC Capital is a long-short equity fund primarily. We really were just basically a catalyst-driven intermediate term trading shop. At the time, it was kind of interesting because the business was changing. The way people invested in stocks, pros, retail. There hadn't been any sort of mania that had kind of captivated investor attention the way kind of the emerging technology bubble had. And so, at the time I was 24 years old, I think, and this desk was filled with a bunch of young guys, testosterone driven. They were looking for action. And so, we were looking for short-term trading patterns, but it was interesting because at some point in 1997, Steve Cohen, who ran the place, kind of brought out a guy and who, didn't look like the traders on the desk. He was wearing glasses and Dockers and a button-down, shirt and everything like that. And he said to one of the traders, "This is your new partner. He's an analyst. I just hired him for Prudential Securities, and you guys are going to be covering this space. He's going to be doing the fundamental research. You're going to be doing the trading, the technical, the execution, all that sort of stuff. You guys are going to bring me your best ideas that I could look to invest in, that sort of thing." And so really I was there at a point where, the kind of aggregation of skill sets was really becoming something that didn't exist in the short-term trading world. And so from there, billions and billions of dollars in profits have made just that organization alone, but it really kind of spurred a whole sort of industry. So I ended up working with a group there that I worked with for years, and then ultimately, that was just kind of trading long short equities directionally. We traded some options, but this is really what's interesting about my career path. This is now 18 years later. I started out trading equities directionally, and at one point about 7 years ago, or a little more than that, I was kind of charged with taking this fundamental event-driven strategy and integrating it with a volatility overlay, if you will. And so there again was another aggregation of different skill sets. So I guess the takeaway from my experience, in the first 18 years of my career would be that whatever you start doing, be prepared to kind of, merge those skill sets with others and build on it, that sort of thing. But for me, that's clearly what's happened. I've kind of used each step of the way as a building block. So now I find myself doing, and what we do at riskreversal.com is really kind of, we do a lot of the stuff that I was just talking about. We like to look at trade setups. We like to use different inputs. It could be a fundamental input. It could be a technical input. It could be some sort of activity we see in the options market. It could be a whole host of different things. But what we try to do is kind of figure out how to express that view using the best way possible, really from what we would say is kind of from a thinking about it from a risk-adjusted basis. So my business right now, I have an institutional options brokerage business. I do trade structure advisory with some asset management firms, and then I have riskreversal.com, which is really geared towards retail traders, people just at home, DIY kind of investors, traders, that sort of thing, who are looking to kind of educate them into the different uses of options to kind of express their views in the equity and equity market. So that's me in a nutshell.
Dan, this is Brianna. You already started to answer what I wanted to ask you. I was very
Mm,
curious about why you started Risk Reversal because I know on your website you emphasize that Risk Reversal is not a trade service and that you're
yeah.
not a financial analyst or a stock or options guru. So, what inspired you to start it?
Yeah, well, it's interesting. So when I was leaving Merrill, and this was the beginning of 2009, I was trading a proprietary book there, and they were not going to be paying traders anymore to do that. I mean, just because of incoming regulation, that sort of thing. So when I was leaving Merrill, I was going to go broker options to institutions, and I actually had somebody called me from CNBC and say, your name came up. We're looking for somebody who can kind of walk and talk and trade options and do it all at the same time, because we're looking to staff a show to retail investors to kind of talk about the different uses of options, which to me, I had never spent any time interfacing with retail investors. So, we started doing this show in probably early 2009. I'd never actually done a minute on TV. I never in a million years thought I would ever be on financial TV. And we started doing Options Action. It was on every Friday. And the show, literally, it was like an infomercial. It was at 11 o'clock at night on Friday nights at first. Can you imagine the sort of viewership that it had? But it started really catching on. And it was like they were looking at the pre-rolls online, and they were looking at the DVRs, I guess, however they track it. And so within a year, the show was on at 8 o'clock on Friday. And the show was doing really well at 8 o'clock on Friday. And then ultimately, they cut into Fast Money, which is the post-market show that's on every day on CNBC from 5 to 6 Eastern, and now we've been on for years now at 5:30 to 6. So interestingly enough, that progression is there's demand for it. There's people who are really interested in learning how to use options. So to answer your question, Brianna, I mean the site was an outgrowth of all the email and the requests. I was starting to get a lot of requests like, oh, that trade structure that you just detailed on Options Action. I get an email about this or a tweet or something like that. How would you apply it to this? Why wouldn't you do this? It was just a ton of interest in this. And so, I really just started to say, wow, I mean, I have given one trade idea every Friday afternoon. It sounds like people want more, and they actually want more detail about those trade ideas. So I started putting it down on the web, and created this brand, Risk Reversal, which is actually an options structure. And so it's been a really great way for me, because I do TV a few days a week. Often one of the biggest criticisms I think about financial TV is that it's very soundbitey, right? You're on there, you have 15 seconds to make a point, and I never really loved that. I mean, I like doing what I'm doing on TV, but I love having an outlet to put all my thoughts down, and I can always refer back to it, and I can always say, well, this is what I said here, and that sort of thing. So there's a certain level of transparency, but just to button it up, we are not a trade service, okay? If you subscribe to this service and you read us, and listen, first of all, you don't even have to subscribe to it. A ton of our content is not behind a paywall. We really just want people reading it and looking at it. We do not have any ulterior motives here. We don't have an execution system or this and that or whatever. So the point is that, I kind of believe is the more investors get to understand the uses of equity options, I think the better that they're going to trade, invest, the whole drill. So, I mean, it's really out there as an exercise for me. Ultimately, at some point, we may turn it up and try to make it a bigger business than it is, but we have thousands of readers a day. We got lots of great feedback, and we think it's a really nice resource. And so at some point, if I take it from being a hobby to a real job, I think it could be a really new kind of innovative kind of place for options education.
Hey, Dan, I want to take you a little bit back here to those
Sure.
those days at Merrill. And
Yeah.
I had my brother-in-law was working there in mid 2008, and he just wanted out. I mean, he had been there for a long time, had
Yeah.
moved up the corporate ladder, and he had told them he wanted to leave. They had offered him a buyout, and they really wanted him to stay, but he just wanted to leave there. He didn't like the atmosphere, the things that were
Mhm.
going on, and and he got out of there, and I thought it was like, oh my God, could be the greatest sell signal in the world, as it turned out to be. You hung on through 2008, and then you left in early 2009. The forced merger with Bank
Yeah.
America. I mean, going back to those days. I mean, you were there when the company was completely falling apart. I mean, what what was your take on that? And
Well, it's a great question, and you know what's interesting is that my whole career I had worked at places where it was an eat what you kill. It was a pure meritocracy. If you did not make money in a quarter, in a year, you didn't make money. You know what I mean? There was no safety net, right? And so, my first experience at a large institution was in 2007, after I'd already been in the business for 10 years, and you know I actually had a few opportunities to go to different banks. A lot of them were moving into proprietary trading in 2006, or expanding their proprietary trading, which is a little ironic in hindsight when you think about what were the issues that kind of put the banks and the whole financial system to stress. It was these guys taking untold amount of risk. But so what was it like to be there? It was pretty fascinating. I will say this about my time at Merrill. So I worked in their equity derivatives group. At the time, it was one of the most profitable groups in the entire bank. To the point where in Q4 in 2008, John Thain, who had already come in to replace the CEO who had left earlier that year, had mentioned the performance of the equity derivatives group. I think we made $1 billion or something like that in the quarter. I mean, we just had a lot of long ball bets on. You remember what was going on? The VIX was at 90, and
right.
everything was going crazy. So for me, it was an amazing time from a market standpoint. The people I worked with there, I'd never worked with better people in my life. I can tell you that right now. I mean, that is a fact. I mean, the people at Merrill Lynch were fantastic in the equity link space, that I was involved in. But there were some pretty nasty days. I mean, we all saw the pictures of the Lehman guys leaving with their boxes, once they went under. I mean, the morning that Lehman went under, we walked in, I think it was September 19th on a Monday or something like that. I mean, Merrill was going to be next. I mean, that was it, but they saved us. And so, people, we went to work that day. I mean, tens of thousands of people went to work that day expecting to kind of just walk out and be done, So it was a pretty fascinating thing. I mean, listen, a lot of the leverage ratios, I mean, a lot of these places have been rejiggered, 100%. They're just not the same places to go and work anymore. I don't think the opportunities, I say this to young people all the time who want to get into finance. I don't think going to work in an investment bank is the best place to start anymore, because I think that the career track is entirely different. I think if you want to go there and get in their analyst program and learn a skill set and then move on, I think that makes sense. But the days of going and having a 30-year career and making gazillions of dollars, I think it's going to be a different track from here on out.
Okay, I was doing some research. Ackman's been in the news a little bit, and the whole Herbalife thing that has come back down has come his way a little bit. And in my research, I ran across some of your comments where you had you had noticed some things going on in the OTC market that could have been Ackman related, and I saw the stock come back down under 38 a couple weeks ago and just hung on there. I mean, it's hard to tell. He converted his options positions. Whoever took the other end of those trades had to act in the market. Is it how do you pick up those derivative trades? And then as far as Herbalife, you think Ackman's lightened up a little bit?
Well, that's a really good question about certain options. Let's just talk about it in the context of kind of the way a lot of people see options activity or large options activity. And I think in a situation like Herbalife, it's just so pronounced because we really know that there's one huge holder, which is Carl Icahn, who owns I think 18% of the shares, and we know that 30-some% of the shares are are sold short, and we know that Ackman is a big portion of that. So anytime there's large activity in the listed market, people are associating it with, especially when there's been a ton of put activity in the Jan 15, which is in a couple months expiration, and then there's a big roll out to Jan 16, which is over a year in the Jan 50 puts. People are associating it clearly with some sort of activity with Bill Ackman. Now, here's the thing. Over-the-counter means over-the-counter for a reason. It means there is no transparency. I mean, that is a transaction that has gone through with a couple different counterparties. They know who each other are, obviously, but it's not, listed on any exchange. And so some of the activity, I get questions, people ping me on Twitter or email, is, oh, I just saw these, somebody's buying calls in Herbalife. That's really bullish, right? Well, you don't know. I mean, you don't know what's going on there, because Ackman could have bought a bunch of over-the-counter puts, and maybe the market maker that he actually transacted with is doing something in the listed market to kind of hedge out that position, right? So if Ackman's buying puts, then the dealer is selling puts, and he's got to do something either with the stock or with options to basically hedge out that risk. So, so what I would say about that is, be very careful about what you're seeing in what some people out there. There's a lot of people, in the financial media on the web who are very touty about unusual activity, and usually, unless you're talking to the people that have transacted it, you have no idea what they're doing. And to trade off of it is almost irresponsible in some ways, unless you already have your own convicted view on the name and it's just one input that you're using. So that's like almost a PSA, I would say. I think there's a massive misinformation that goes on in the financial media, and those claim to be option gurus and this and that or whatever about unusual activity. I do not believe that it is an investable strategy chasing unusual activity, because you don't know what's going on. As for Herbalife, this is a story that I've read a lot about, I've written a lot about. I'm not currently involved in the name. I have no position. I have had bearish positions, and I think Ackman is onto something, whether the FTC comes in and labels it a pyramid scheme or not. So I think this is a company that has basically seen their earnings power dramatically impaired by some of the actions that they've taken to get in front of the FTC or potential regulatory issues here. They've already had 2 consecutive earnings misses, the first time they've missed earnings since 2008 in the last 2 quarters. They've been levering up to buy back stock. They're using like every ounce of their cash flow. They suspended their dividend to use that money to buy back stock. And what are they doing? They're just trying to squeeze Ackman. So it just seems like a really scuzzy company to me. And every time I say this, I get a million hate mails and stuff like that. I mean, I just think there are much better places to be than to try to pick a bottom in Herbalife. And that being said, I wouldn't short Herbalife here. I mean, Ackman thinks it's a zero, fine. He's bet, $1 billion of his investors' assets that way, you know what I mean? But I don't think me and you have to get involved in something that has the potential to be a very binary situation where the information flow is pretty limited, and there may be some funny stuff going on there.
And you're the first person to use SCSI on Benzinga's pre-market prep, brought to you by MarketFi.
Dan,
Nice.
you mentioned that you do a lot of trade structure advisory through risk reversal. So I wanted to ask you, what do you think are the 3 primary uses of equity options for equity traders?
Sure. I mean, this is something that we use a lot in risk reversal. So for me, there's first and foremost, I think is risk management. And I think that, and this is a really important thing to kind of get across to people that, a lot of people, they're long stocks and they buy puts and they think that's risk management. Well, that's a synthetic call if you're long stock and long put, and it's kind of an expensive call. But, really what we're trying to do is express the fact that, you have alternatives to just owning stock or shorting stock or selling stock that you're long. So we think about it from this point. You can use options to add yield. You can use options to add leverage to your best positions. And, like I said before, for risk management. And risk management can really mean, let's just say Apple, it's gone up 25% in the last month, a little more than a month. And when you think about it, you do the math, that's $200 billion in market cap. Stock's gone up in a straight line here. And so to me, risk management strategy would be, well, option prices are pretty low in Apple, and I just had, let's say maybe I have 40% gains in a year, a $700 billion market cap company. How far can it go? Well, I want to lock in some of those gains, but I still want exposure to the upside, right? So you could maybe consider, selling your stock. I know a lot of people don't like selling huge gainers at the end of the year for tax purposes, but, maybe you sell a portion of it and then you use some of the proceeds to buy a call or a call spread and replicate some of that bullish exposure that you have with long stock, but there you've gone and defined your risk. So, risk management, most important one. Yield is is really, maybe you consider selling calls against your Apple stock, despite the fact that option prices aren't that high, but maybe taking a little yield, and especially for a situation where some people like to use good till cancel limit orders, right? Maybe the stock's at 119 this morning and you want to put out, if the stock trades at 125, I'm out, I've sold. You give your order to your broker and you say, I would sell 100 shares at 125. Well, you could just do this. If you could just sell, a 125 weekly call. If the stock went there, you get called away, but you took in a little premium and you have that order. Now, the only thing that doesn't really do, though, is protect you to the downside, which is why we like the idea of stock replacement strategies. And then just purely leverage. Let's just say the stock's at 119. This is Apple again. You think the stock's going to 130 in January. Maybe you want to lever up your best idea. Maybe you buy a 1-by-2 call spread against your Apple long position that would give you, some type of exposure to juice your upside return. So to me, what we really try to do at Risk Reversal all day long is look for these setups, look for opportunities and names that we know are very active, or we know that people should be looking at because there's interesting catalysts coming up, and we're basically laying out different ways to express those views using those three kind of ways that we like to use options.
All right, we have had Dan Nathan on the line. He is the co-founder and editor of Risk Reversal, taking time out from his busy morning to come on our show. Dan, thanks a lot. Great information, and I hope we can have you on again.
Great. Thanks, guys. I really appreciate it.
Okay.
Thank you,
Dan Nathan, what a great interview, getting a perspective on the old days, the dark days at Merrill there, and looking forward, good risk management talk there in the market.